Good morning, everybody, and thank you for being here with us for the monthly update on the Hedge Invest Numen Credit Fund. The year of 2018 started on a good note for us. We managed to take advantage of some of the macro dynamics that developed during the month, in particular the movement we've seen on interest rate. We remain quite negative on the interest rate and fixed income market at large. We think it's very overvalued, in particular in Europe. We think monetary policy will normalize and possibly will be forced to normalize on an accelerated basis if and when we see continuation of the very strong data, and in particular in terms of the implication of that strong macroeconomic data on the labor markets and the famous Phillips curve. We think, in particular in the case of Europe, post-Italian election, which would expect to be, similarly to the rest of the market, as a relatively mild event, we do expect an acceleration from the ECB. While at the same time we remain incredibly negative on UK because of Brexit, and we've been adding position on that from a short point of view, both on the financial institution and on options on the currency. Away from that, on the banks, if you want, the map continues to be working. Obviously, if interest rate normalize, it will be a good driver for profitability for banks. Like we said for the last few months, at the moment we like credit issued by banks, security issued by banks, but we're very, very wary of the interest rate sensitivity. And as we've seen in the last couple of days, the sensitivity of 81 and subordinated debt to interest rate is very high and much higher than what people would have expected because of the liquidity condition, which we don't think will improve substantially in the next future. If anything, it will go worse and worse over time. Once the interest rate normalization becomes a little bit more pronounced, more stable, then we will move to the long equity side. At the moment, our long-short equity is performing quite well versus our expectation, given the volatility in the market, and we think that will be a great source of revenue if and when the interest rate move will start filtering through the profitability of banks. Last sector that we look at, obviously, is the corporate. That's where we see a lot of volatility. We remain very negative and very short, and we keep on adding to the short on the corporate market. We think corporate credit is the most exposed. It's over-levered, has been a target of both the ECB and the Fed quantitative easing, which are about to be stopped. We see a lot of M&A activity. Most of it will be very highly levered. The credit market is about to turn, and we do see this technological winter coming where a lot of traditional companies will be challenged by much cheaper alternatives based on new technologies and new companies adopting those new technologies. So we remain extremely negative on the credit markets at large and fixed income at large. Obviously, we need to be very mindful of gap movement, but we think the trend in 2018 has definitely established itself in line with what is our strong expectation for both macro and micro drivers. With this, I thank you very much for your time and attention, and I hope to hear you and see you next monthly update and at the end of February. Thank you very much.